Another AWS cloud outage just took down half the internet. From Coinbase to Disney Plus, one point of failure exposed a multi-billion-dollar risk. But for a hybrid multi-cloud pioneer like Nutanix, every single public cloud failure is a massive opportunity. Nutanix allows companies to run their apps anywhere, on-prem or across multiple clouds, making them outage-proof. With the Broadcom VMware drama pushing customers their way, is this cloud stock the ultimate buy for cloud resiliency and explosive growth? The multi-cloud tailwind has been a top leadership priority for several years now, with 89% of enterprise executives executing against a multi-cloud strategy. There are three key reasons why the multi-cloud tailwind is accelerating. First is the desire to avoid a vendor lock-in. The hyperscalers know that once you store your data on their servers, that it is very hard to migrate away. To hedge against constant price increases that these hyperscalers may give them, enterprises will utilize the Nutanix software platform to enable a constant platform that is agnostic of the cloud provider and is a seamless migration between clouds should ever come to it. This allows customers to maintain some leverage with Amazon, Google, Microsoft against just continuing price escalation, especially in this environment when the generative AI is causing a supply shortage of compute available. The second reason is to cover peak compute demand. Some highly regulated industries, like banking and medical, require the storage of highly sensitive information on-premise in a private cloud. To optimize for costs, the company would ideally just use their private on-prem server for the required data and use the far more cost-effective public clouds to service everything else that is allowed. Nutanix Cloud Platform is what enables these blended private and public cloud capabilities. The third reason for why multi-cloud has become more popular is the main one for me that I'm most excited about, and that is data resiliency. When we have outages, even though they are rare, this leads to major revenue losses, which the top 8 companies were projected to lose $75 million in revenue during the outage per hour. Again, that is per hour. This is real lost sales that can simply be avoided by using Nutanix's multi-cloud software. So these are some very strong reasons for enterprises to be pursuing multi-cloud, and the financials also back Nutanix up on this too. Nutanix has grown its revenue consistently over the past 5 years and is now a $2.5 billion revenue company. Most importantly, they have transitioned from a low-margin hardware and licensing supplier into a subscription model, which has improved free cash flow tremendously from negative in 2021 to positive 30% free cash flow margins in 2025. Nutanix isn't a small niche concentrated provider either, as they've consistently grown their customer count every quarter, and now they have over 29,000 customers dependent on their platform. So Nutanix has a desirable product that enterprises are clamoring to use to modernize their cloud infrastructure, and the revenue has grown at double digits with GAAP profitability. Now let's look at my 2030 valuation for them. So the revenue in 2025 is expected to be around $2.5 billion. Assuming they continue their strong revenue growth of 18% annually, they will generate $5.7 billion in revenue in 2030. For free cash flow margin, I'm going to assume they have a 20% margin, which is typical for high-quality SaaS companies. This is lower than the 28 and 30% margins in the past 5 years, which I believe is temporarily inflated due to the transition to the SaaS model. For price to free cash flow multiple, I will use a multiple of 16, as this is what Broadcom acquired VMware for at the $61 billion valuation a couple years ago. So putting all this together, and it gives Nutanix a $18 billion market cap for 2030 based on these fundamentals. Not too great upside at all. So 2 other watchouts that are most concerning to me is, first, they must continue to have strong free cash flow. Reason for this is they have an enormous amount of debt in convertible notes that they cannot afford to have a bad quarter of negative free cash flow moving forwards, or else this company will sell off. Second watchout is VMware. In the short term, many former VMware customers have migrated to Nutanix due to significant price increases after VMware was acquired by Broadcom. If VMware were to scale this back, perhaps they can stop the bleed-in in customer migrations, which thus far has accelerated Nutanix's revenue growth. Now, before we look at the technicals and run Nutanix through our frameworks to determine whether to buy, please read the disclaimer in the notes below. We're not financial advisors, and anything we say should not be taken as financial advice. Also, if you like content like this, please help us out and click a like and subscribe as we aim to analyze the most innovative companies twice per week. Now let's look at Nutanix through my 5-point framework. From a leadership perspective, I give Nutanix CEO Rajiv Ramaswamy a strong. He was a former chief operating officer at VMware and has turned Nutanix from just an HCI company into a true platform company through integrations with all the major cloud players. This focus on openness and integration, along with phenomenal customer service, serves as an advantage for Nutanix as they take share away from VMware. From a valuation perspective, this is a very weak. My 2030 valuation model shows an $18 billion market cap, which would be flat from the price today. My target is 15% annual upside. For revenue and profit growth, I give this a strong. 18% annual revenue growth with 20% margins are great. With the transition to a subscription model, the revenue becomes recurrent as well, which is a plus. For total addressable market, Nutanix quantifies their market as $76 billion, in which they've captured less than 5% of it. I'm less optimistic though on this, as I do think multi-cloud has a huge untapped market. But competition with VMware will be tough, coupled with competition from any of the hyperscalers should they try to make their multi-cloud software more agnostic. For tailwinds, I give this a strong. We've all seen data center build-out stocks surge due to explosive demand from generative AI. Multi-cloud needs will just ride on these coattails. Overall, I do like the multi-cloud environment, and I do believe revenue will continue to grow double digits for the next 10 years for Nutanix. However, the valuation and competition with VMware is just too much for me to overlook, so I am a no. The stock has run up over 175% over the past 5 years, so I do believe I'm just too late for this phenomenal company. What do you think, Dad?
Thank you, Scott, for that wonderful presentation and analysis. I like to do my technicals for Nutanix. So for the company fundamentals, it has no dividend. The beta is 0.5, which means it's 50% less volatile than the S&P 500. The market cap is 18 billion, and earnings comes out on November 25th. So for that, I'm a neutral to positive. And then for earnings history, the last 4 quarters, it's beat 4 out of 4 quarters. So that's positive. And then now for the financials, the net profit margin is 7%. The debt to equity they have negative equity. So you can't even really measure it, but that's not good at all. I don't see that very often for a company to have negative equity. The PEG ratio is around 2.8 to 3. The forward P ratio is around 37. And the earnings growth rate projected is for the next 3 to 5 years is 12%. So that's how they get the 3 number. And that's not bad for a tech company. I don't really like it to be above 3, but it's right at 3. So for that, I am a neutral because of the debt and the net profit margin is kind of low. And then for the stock technicals, as you can see, the moving average is almost at the 250-day moving average is almost at the 200-day moving average. And if the 50-day goes below the 200, it's called a death cross, and it's not good technically. And I believe a lot of focus on that if they intersect. They focus on a 50-day and 200-day. So if they do intersect, that's not a good sign. So this is a very critical time for Nutanix. If we look at the Bollinger Bands, as you could see, it's bounced off the lower band and it's went to the 20-day moving average, which is the middle band. And as you can see, it's not really that volatile, pretty consistent, except for in the middle of the Bollinger Band. Kind of got a little big, but and a little bit a few weeks ago. But anyway, so it bounced off the lower band, and it's right at the middle band, which is the 20-day moving average. So a lot of things are going on technically. The slow stochastic oscillator is 36, which is neutral. The MACD is interesting because the negative, it had negative histograms. The bars were negative, and now it's almost going to zero. So that's a critical point too. Let's just say that it's neutral, and it's a critical point right now because it's almost ready to flip from negative to positive histograms. The unbalanced volume is positive. So for that, I'm giving it a neutral because of the closeness of the 50-day and 200-day. And if it does, if the 50-day goes below the 200-day, then that's technically, they call it a death cross, and that's not good. Obviously, because of the name and such. So anyway, for analyst coverage, one strong sell, two holds, 3 buys, and 1 strong buy. And the price ranges for the analyst ranges from 79 to 95. And the institutional holdings is 87%, which is very good. And that means that it's very hard for institutions to sell a lot of shares. So that typically dampens the volatility. So that's a good sign. So overall, I'm kind of in the middle, and I just want to see what's going to go on next week. I like the company, what they do, but the death cross is just too big of a critical point, and with the histograms flipping. So right now, I'm a neutral. So I'll hand it back to you, Scott.
Thanks, Dad. Overall, we are both a no for Nutanix. This is because a valuation for me and for my dad John is due to its technicals and approach in the death cross. Lots of data center exposure stocks ahead for us to analyze to hopefully find a better one for our portfolio. With that said, thank you for watching. Please click like and subscribe to keep up on our journey as we analyze the most innovative companies twice per week. Until next time, happy investing.